month on month, and it stood at approximately rupees 720 crore in April 2022, which was at about 129% of April 2019. We have further seen very strong trajectory in the first 3 weeks of May 2022, and the consumption across our portfolio is up over 25% when compared to the period of May 2019. In line with consumption growth, our retail rental collections have also improved substantially. In Q4FY22, our collections stood at approximately rupees 476 crore, while for the full year of FY 2022, it was at about rupees 1,174 crore. Collections remained strong in April 2022 at over rupees 170 crore. I'm also glad to share that we have resumed marquee events, live concerts and activations across our malls in the recent months, post the easing of restrictions, which has further aided consumption growth. Overall, we are cheered by the momentum that has been built up in consumption across all our malls, and we are confident the trend should continue going forward under normal operating conditions. Moving on to our commercial office business. Our office portfolio continues to remain resilient. We have seen strong leasing traction during the financial year FY 2022, with gross leasing of approximately 4 lakh square feet. Collection efficiency for the office portfolio was at 96% in FY 22. Office income was up 22% year on year at approximately 158 crore. The office segment has benefited from rental contribution from Fountainhead Tower 2 at Pune in FY 22 as well. The leasing momentum has continued in FY 23 with gross leasing of over 120,000 square feet during the months of April and May. Our hotels business has shown strong improvement on the back of higher occupancies, social events and food and beverage consumption. Revenue for March-April 2022 is 4% higher than revenue for the pre-COVID comparable period of March-April 2019. In Q4 FY22, we witnessed gradual improvement in average room rates and occupancy levels, which have breached pre-COVID levels, despite the transient impact of the Omicron wave in January 22. I'm pleased to inform you that occupancy levels reached 90% in the month of March 22 and 92% in April 22 at the St. Regis Mumbai, while ARRs in April 22 are at approximately 11,700 rupees and at par with pre-COVID levels. Further, for May 22, we have seen ARRs crossing rupees 12,400, which are far above the pre-COVID levels. The operating performance at the St. Regis Mumbai has surpassed most parameters in the past couple of months, led by resumption of foreign travel, domestic corporate travel, social events and staycations. These factors provide an excellent visibility for higher occupancies and ARRs in the coming months. Additionally, most venues on the hotel's 37th and 38th floor were under renovation and did not contribute to the revenue in the last financial year. And they have opened, a few of them have commenced operations in the last week, and the others will commence operations during May and June, which will further add substantially to the monthly revenue run rate. Our hotel at Agra, the Courtyard by Marriott, also had a good quarter and contributed approximately 8.4 crore in Q4 FY22, with average Q4 occupancies of 55% and ARRs breaching 4,300 rupees. Moving on to the residential business, we have witnessed very good traction in residential sales, mainly led by the reconfiguration of our Kesaku development into smaller apartments and the robust demand for ready-to-move-in inventory. Overall sales in FY22 stood at about 341.5 crore, out of which 153.5 crore of sales is pending registration. We have booked sales of about 180.8 crore in Q4FY22. Collections in Q4FY22 were at rupees 97.8 crore and for the full year at 276.5 crore. During Q4FY22, we registered agreements for inventory worth 57.9 crore, and for the full year, this number stood at 188 crore approximately. We continue to see a strong build-up in demand and faster conversions for our ready inventory. We are stepping up our efforts to sell inventory by launching attractive subvention schemes for the entire development, special offers on ready-to-move-in apartments, and digital marketing campaigns to widen the reach of our product. Momentum in sales is expected to continue in the coming quarters as well. Moving on to an update on our under construction projects. Our current pipeline of under construction malls: Phoenix Millennium at Wakad, Pune, Phoenix Citadel in Indore, Mall of Asia at Hebbal in Bangalore, Palladium at Ahmedabad, and the new mall in Kolkata will take our portfolio to approximately 13 million square feet of retail GLA. Construction work at all our sites continues in full swing, and retailer interest for leasing spaces at our malls remains extremely high. We have seen some fantastic traction on leasing in the quarter gone by. Phoenix Citadel Indore is expected to open around September 22. We have seen approximately 74% of the retail GLA being leased so far. Phoenix Palladium Ahmedabad will also be open to public by mid of FY23, and we have already leased 85% of retail GLA here. Phoenix Mall of the Millennium in Pune and Phoenix Mall of Asia at Hebbal, Bangalore should become operational by the first half of FY24, with Phoenix Mall of Millennium Pune currently being leased at approximately 51%, and Mall of Asia is currently leased at approximately 66%. At our flagship property in Lower Parel for the new development Project Rise, we have received the environment clearance for the project and we have awarded the initial shore piling contract. We expect to commence excavation soon. For our Calcutta project, we have received approvals of the building plans in April 22 and expect commencement of work in the coming months. We have already commenced work on expansion of our Mall of Asia development, with Asia Towers construction having commenced. Construction for offices at Wakad, Pune, and at our existing development Phoenix Market City, Bangalore at Whitefield will also commence shortly. In the last month, we also concluded a stake purchase from our partner in Classic Mall Development Company, taking our stake up to about 200%. 50% of the equity stake in Classic Mall Developers was owned by Crest Ventures Limited and Escort Developers Private Limited, a 100% subsidiary, and Phoenix Mills Limited owned 50% in the company. Post this acquisition, Classic Mall is now a wholly owned subsidiary of Phoenix Mills Limited, effective May 5th, 22. For this transaction, Phoenix Mills has paid approximately 936 crore to the sellers to acquire this 50% stake. Crest and its associate companies have repaid ICDs of 251 crore back to Classic Mall. Classic Mall has also received approximately 97 crore on account of the OFCD redemptions from its associate company Starboard. So effectively, net cash outflow for this transaction stands at approximately 637 crore. The company has funded the acquisition by way of internal accruals and cash on its balance sheet. This transaction is a testament to our strategy to prudently deploy capital and consolidate stakes where we feel the investments are most value accretive. May I now request our Group CFO, Mr. Anurag Srivastava to update you on the financial performance. Thank you.
Thank you, Shishir. Good morning, ladies and gentlemen. Thank you for joining us on this call. Continuing with the briefing which Shishir gave, I would like to share with you some of the key highlights of our consolidated financial performance. Income from operations for FY22 was about 1,483 crore, which was up about 38% year-on-year basis. Income for Q4 FY22 was 495 crores, which was up 28% year-on-year. EBITDA for FY22 was about 733 crores, up 49% year-on-year, and for Q4 at 241 crores, up 39% year-on-year. Reported PAT for FY22 was 263 crores, and for Q4 was 117 crores, which is up by about 101%. Q4 FY22 retail EBITDA mirrored consumption recovery and came in at about 106% of Q4 FY19, which is a pre-COVID quarter, and about 119% of Q4 of FY20. FY22 retail EBITDA was about 80% of FY20 retail EBITDA. Moving on to our commercial office portfolio, the commercial office portfolio reported a total income of about 43 crores in Q4 and EBITDA of about 27 crores. Our total commercial income for the year was at 158 crores and EBITDA of 98 crores. On the hospitality end, 58 crores in Q4 FY22 and 173 crores for the full year FY22. On the collection side, we had a very good year for collections, and we collected about 1,800 crores of collection. I'm just rounding off the numbers. Retail collections were at about 1174 crores, commercials at 169 crores, residentials at 277, and hotels at 173. During the year, we also did multiple transactions with our long-term partners, CPPIB and GIC. Total inflow from these transactions was approximately 2,600 crores for the year. We have further funds of over 1,150 crores, which is to come from these transactions. This is certain defined milestones across our projects in Calcutta, Lower Parel, and our continuing investment from GIC on the Vamona and Offbeat properties. Our capex was about 267 crores for the quarter and 1,200 crores for the entire year. FY22 capex includes amounts spent towards acquiring FSI and approvals for the office-led mixed-use development at Lower Parel for about 350 crores, as well as payment towards land from Plutocrat to PML of 350 crores. Including these expenses, balance capex across rest of the portfolio is about 700 crores. As Shishir mentioned, we are targeting a Diwali launch for our malls in Indore and Ahmedabad, and a FY24 launch for malls in Wakad and Hebbal. As a result, we'll see an increase in spending in these malls towards this year as we near completion of these 4 malls in next few months. Further, during FY23, we expect to commence construction at a retail site in Kolkata as well as Lower Parel, the commercial site. We also intend to commence construction of offices on top of our operational malls in Whitefield, Bangalore, as well as under construction malls in Hebbal and Wakad. Therefore, our capex estimate for FY23 is approximately 1,600 crores. We have currently secured additional construction finance lines of 1,000 crores to fund the final leg of completion of our under construction malls in Indore, Wakad and Hebbal. So far, construction of these malls have been funded entirely out of equity, and now for last 6 to 12 months of funding, we'll draw out on some of these construction finance loans to fund the balance construction. Coming to the debt side, our consolidated gross debt stood at 4,380 crores as of 31st March 22, compared to 4,300 crores at the end of Q3, which is up by 75 crores. The increase is mainly on account of drawdown of debt towards under construction mall at Ahmedabad and Indore, as mentioned above. Average cost of borrowing is down to about 7.3% from 7.61% in December, and 8.17 in last year, March closing. Currently, our lowest cost of borrowing stands at 640, and we've been renewing some of our portfolio at 640 to 675 levels. During the year, we have refinanced about 55% of our gross debt and were able to drive significant reduction in interest rates. As overall interest rate in the economy starts to rise, our effort will be to minimize the impact of this on our cost of borrowing. We have potentially another 30% of our debt portfolio which we aim for refinancing during FY23, which could yield us interest rate benefits about 30 basis at a portfolio level and offset a large increase because of the rate increase by the RBI. For our office construction across portfolio and new mall in Kolkata, we'll continue to fund the construction in the initial period by way of equity. On the liquidity side, our liquidity position on 31st March was almost 2,500 crores. This includes 619 crores of unutilized OD accounts. Compared to March 21, our liquidity position is improved by 1,750 crores, while gross debt has reduced by approximately 130 crores during the same period. At a group level, our net debt is about 1,880 crores and PML's share of net debt is 1,253 crores. We are bullish on our business prospects, and with a strong balance sheet and an improved liquidity position like ours, our focus is now to deliver on our under construction projects in time and judiciously deploy our capital to expand our portfolio. With this, we would close our opening remarks and we'll open the call for interactive questions and answer session. Thank you.
Thank you. We will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question from the line of Parikshit from HDFC Securities. Please go ahead.
Hi, Kushal. Congratulations on a very strong quarter, and especially the month of April. My first question is on consumption. You can help us better understand and give granularity on this consumption growth of about 29% versus 19. If you can give more granularity and how is the mix changed in terms of tenants, how much is the contributing factor from there, how much is the contribution from inflation research. So if you can give some color there.
Thank you for your question, Parikshit. If I understand correctly, you'd like us to break this down on the contribution to the consumption growth coming from inflation. Is that your question? The line is not very clear.
Mr. Parikshit, I would request you kindly go off the speakerphone as there's a lot of disturbance coming from your background.
Yeah. So I was talking on inflation as well as on the base business side, if there has been any changes in the client mix, and you would have removed some non-performing clients. So the rejig in the entire client portfolio, because what I understand that the trading density is still 10% lower versus trading occupancy versus lease occupancy. But still we are delivering almost 129% of after 19 numbers. So this number looks to be on a higher side. So this will be a breakup on the change in mix and also the contribution coming from the inflation.
So really, we've not seen a change in the brand in the category mix as such. We have seen a churn in brands within categories. As you are aware that there were a few brands that could not survive this period of COVID, and certain brands which were not performing, we had to churn them out. Despite that, as you rightly pointed out, that trading occupancy may be low. Our occupancy continues to remain across the board in the high 90s. Trading occupancy may be low because of several brands being under fit out during this last year. In context of the contribution, we've seen footfalls recover to about 85% or thereabouts in this last quarter as compared to pre-COVID level. But the average spend per customer has gone up. And also, as covered previously, a lot of the trading density remains quite high, with many stores not being operational and yet consumption moving up. Now, it's very difficult with 300 plus brands at each location to really deep dive to understand how much of the growth has been as a result of inflation. To my knowledge, price escalations have, if any, have only happened from the retailers' end in the last month or so. But generally, it is the consumption. Our sense is that the number of SKUs sold at all of these locations would still be higher than the pre-COVID period. So that is certainly not getting. There's not a significant contribution of inflation in the last quarter. Going forward, yes, one is likely to see that.
So that was my next question. So do we now see a higher consumption growth? Because if I compare last few years, consumption has been growing at about 7 to 9%. And now if I adjust for the Lucknow consumption, like to like, the consumption is about 18% higher on the April 19 base. So if you're saying that inflation is still not very meaningfully contributing to this consumption growth, so the dual impact of inflation hitting in as well as trading occupancies moving towards these occupancies, the base business growth on consumption could actually surprise positively in the coming quarters.
Absolutely. So we are already seeing this in the month of May. For the first 21 days, we've seen consumption already being 25% higher than May 2019, right? Which FY20 being a big blockbuster year for us. So the base consumption growth itself remains strong, and this is further going to move up on account of price escalations, if any, done by the retailers, which translates to a higher revenue share for us. We are also entering the sale season in June and July, which will also boost consumption significantly.
Okay, great. This is the last question on your business development pipelines. We did touch upon last time about 4 to 5 new malls which you are looking at, like Surat and Chandigarh and Hyderabad and other places. So if you can just walk us through what's any status update on that? Have we tied up any new land, greenfield lands? And lastly, on the capital allocation side, are we now incrementally looking to 100% own these new assets, or again we'll have some partners here? So what will be the capital allocation strategy given very low levels of debt which we have on the book now?
Sure. So we have been actively looking for opportunities. In fact, I'm pleased to mention that we have an in-principle closure for a land acquisition at Surat, along with our partners of the Ahmedabad Mall. We are currently also looking for opportunities for assets owned either 100% by Phoenix or under a joint venture with GIC in cities like Jaipur, Hyderabad, Chandigarh. And this is an ongoing part of our business. I think at every location, one can assume that the mall cost is going to be anywhere between 1,200 to 1,500 crore at an average, and we will be prudent in our capital allocation and not look at high leveraging. And we have the capital available on our own balance sheet and also in the joint venture with GIC. So we hope that in this coming year, we will be able to conclude Surat and perhaps another 2 land parcels between Jaipur, Hyderabad, Chandigarh and another market. And these would be either in the GIC JV or directly owned by Phoenix, depending on how the opportunities are viewed by our partners.
Okay, so congratulations and all the best. Hopefully we soon to hear something on Surat.
I want to just add on to that one point. We will continue with our current approach in all of these new greenfield projects, where we will look at funding the initial stages of construction through equity and look at construction finance only towards the last 18 months or thereabouts of the project cycle.
Okay. Sure, sir. Thank you, Shishir, and all the best to your team. Thank you.
Thank you very much, Harit.
Thank you. We have the next question from the line of Adhidev from ICICI Securities. Please go ahead.
Good morning, everyone. Thanks for the opportunity. The question is now with this strong consumption growth on light. seeing. So versus that, 1,000 odd crores of
Mr. Haridev, your voice is not very clear. Would you kindly go off the speakerphone?
Yeah. I'm on a hands free. Is it better now?
No, it's still not very clear actually. There's some sort of a disturbance that is coming from your handset.
1 second. Better now? Yeah. So I'll just go ahead with my question. My question was, asset growth plus run rate achieved on operation malls.
I'm sorry, Mr. Haridev, but we still can't hear you very clearly. Can the management hear Mr. Haridev clearly?
No, we cannot.
No. Mr. Haridev, I would request you to kindly join back in the queue. Probably reconnect to the call because there's some sort of a disturbance in your line.
Is it better now or? Can you hear?
No, sir.
Okay, fine. I'll come back. Yeah.
We will now take the next question from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi, morning. Thanks for taking my question. My first question was on your Phoenix Palladium. Now, if I look at your consumption at the Phoenix Palladium pre-COVID versus pre-COVID, it's almost at 98%. But your retail EBITDA is at about 85%. And if you look at most other assets, right, your retail EBITDA is in line with the consumption trend compared to pre-COVID levels. Anything peculiar happening here?
Sorry, could you repeat the last part of your question again?
So for most of your other assets, right, your retail EBITDA as a percentage of your pre-COVID levels is broadly in line with the consumption trend. But in case of Phoenix Palladium, right, it's at your retail EBITDA is at 85% versus your consumption is at 98% of the pre-COVID level in Q4. So what's happening over there? What's the reason for that?
So we have quite a few upgrades happening at our Lower Parel asset. In fact, we are in the process of adding close to 600,000 square feet of retail space, of which about 200,000 is now nearing completion and will become operational soon. So there are certain expenses which are booked for these upgrades onto the P&L that would have brought our EBITDA percentage low. Additionally, in terms of marketing expenses, we have now amped up the marketing. So in the last quarter, we've seen a few of these live performances, a lot of marketing initiatives undertaken, which would have impacted. But I would say that it would only be an aberration in this quarter, and we should track close to 100% on a normalized basis or even higher than that.
Sure. That's very helpful, Shishir. Again, second question related to Palladium again. The 60,000 square feet that we have leased or added this quarter at 300 rupees per square feet per month rent. The rent seems a bit low for that asset. Your comments?
Yes. So this is the new space that we have opened at the lower ground floor of Palladium, of the Palladium structure. And these are minimum guaranteed rents. In addition to this, of course, we have the percentage of revenue. We expect, again, on a normalized basis, this is going to track closer to the average or slightly higher than the average for that building as the stores become operational and consumption moves up. We also have a few anchors which are obviously priced lower than the average for the mall.
Sure. And my last question was on if I look at the markets that you spoke about, right? Surat, Jaipur, Hyderabad, Chandigarh, like most of these are like tier 1 cities. So would it? I just wanted to understand your thoughts on do you think metros are kind of exhausted now, or are adequately supplied, or maybe oversupplied in terms of malls? Or would you look at opportunities in metros as well?
No, we continue to look for opportunities in metros where there is a potential. Now, we believe that a market like Pune, where we have two malls, which will be with the one at Viman Nagar and the other one on the western part at Wakad, we've covered that market. However, a city like Bangalore continues to have some opportunities in some markets. We have a city like Chennai continues to have opportunities in some markets. Certain parts of I would say Gurgaon, a certain micro market in Gurgaon has an opportunity for malls. MMR, I would say, the Navi Mumbai belt continues to have an opportunity. So there are specific micro markets in all metros where there are opportunities or rather where there's a huge demand, we believe, and unfulfilled demand in terms of retail mall projects.
Any opportunities in terms of operational malls available for sale in these markets?
Not really. We've scouted the markets extensively, and it's difficult to find assets that meet our quality or design criteria.
Sure. Thanks, Shishir, and all the very best.
Thank you very much.
Thank you. We have the next question from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you so much, and congratulations on the strong numbers. My first question is, how should one think about the minimum guarantee rent for FY23? Will it be fair to assume that the last 2 years, which have been lost, FY21 and 22, the growth would be on the base of FY20, or should we assume a 4-5% CAGR growth in 21, 22 and build in a minimum guarantee for FY23 as well?
That's a very good question, Puneet. So let me answer it by sharing with you that if we look at whatever was the exit rate for contracts that would have ended in FY22,
yeah.
In the current year, where we are looking at either renewals or new brands taking up the same space, we would see anywhere between a 11 to 12% growth from FY22.
Okay.
And again, this is only on the minimum guarantee rent. Over and above this, you would also see perhaps higher percentage of revenue share from the same brand or same category going forward.
Okay.
You may remember, Puneet, that for contracts which were expiring in the year of FY21 and FY22, we had extended those for short terms for 12 months or 18 months, which are also coming up for renewal in this, or have come up for renewal in FY20, latter half of FY22, or will be coming up for renewal in FY23. So we expect to see this growth in the minimum guarantee rent and perhaps also on the revenue share percentage on all of these end of contract renewals or new leasing.
Understood. You had alluded to this percentage share of revenue as well. Will that be applicable for just a small period of time to recoup the lost rentals in 21, 22, or will that be a new norm going into 24, 25, 26, 27?
So I would say for this first half of FY23, we will continue to see a higher rental on account or higher revenue share percentage on account of waiver negotiations or discount negotiations that we had done in the year FY21 and part of FY22.
Yeah.
So we will see a positive impact on that. But for all leasing as well, the revenue share percentage in a few cases should certainly move up.
Okay. And will that, for new leasing, will there be a lower minimum guarantee, or will the minimum guarantee standards remain intact?
No, as I mentioned earlier, we should see a growth in the minimum guarantee rent as well.
Got it. This is helpful. Thank you so much. And my second question is, your malls are close to completion in Indore and in Ahmedabad this year, and Pune, Bangalore next year. There has obviously been a rise in construction costs as well. What impact has that made to your budgets in terms of the total construction spend for these malls?
So I would say, fortunately for the malls that are under construction, we had progressed significantly on the RCC construction until the last 3 or 4 months. So the cost escalation impact on account of price escalations or input costs going up, the impact is minimal. For the subsequent phases of the project, which comprise of offices in a few locations like Hebbal and at Wakad, which are on top of our malls, we are evaluating what is the impact going to be. Steel prices and cement prices, of course, have gone up. But in terms of rupee value, we have to. I don't have a number to share. But already we are seeing some softening in the steel prices in the last week or couple of weeks. So we don't expect to see a significant impact.
Okay, so but there will be impact on the finished products, right? I mean, the marbles or whatever other.
The impact is minimal because all the orders had been placed, even for for elevators, escalators, all the equipment, high side equipment. All the orders had been placed previously, and the pricing is locked. It's only the price escalations that we will see on account of increase in steel prices and cement prices. Will be for the subsequent phases of the construction, which will take, let's say, another 24 months and all, and we expect the pricing to average out to lower than what it is today.
Got it. This is very helpful. My third one is, now that Chennai Mall acquisition is completed, it's paid for, when you did the calculation, what kind of cap rate did you assign for purchase of that acquisition for the mall, for the balance 50%?
So we looked at what are the FY23 revenue, what is the FY23 NOI potential, Puneet.
Yeah.
And in fact, we are currently closing out our budgets for the next year. So effectively, this should be in the range of about a 9 cap based on 1 year forward rentals.
Understood. And lastly, the timeline for completion for Project Rise.
We are looking at a FY26 commencement of operations. Perhaps latter half of FY25 for some part of the retail, but FY26 for the offices.
Great. And if I can just squeeze one more, on your commercial offices, now that you've started, work on a lot of new assets, what kind of demand are you seeing? Has there been any interest for build-to-suit kind of tenants as well?
So we are tracking the RFPs in many markets, Puneet. As you're aware, our current portfolio is about 2 million square feet. And by FY26, we should be at approximately 7.2 million square feet, including the Lower Parel Project Rise. So we've been tracking the RFPs in the markets of Pune and Bangalore, and there seems to be a very, very strong pipeline in both these markets, not just from IT, but also from corporates for front of the house office spaces, which is essentially what we are building. There's nothing remarkable to report right now in terms of any build-to-suit discussions. But yes, there are ongoing discussions with a few tenants who are likely to take up, sizes of 150, 200,000 square feet or more.
Understood. That's very helpful. Thank you so much, and all the best.
Thank you, Puneet.
Thank you. We have the next question from the line of Saurav G from Motilal Oswal Financial Services. Please go ahead.
Yeah. Hello, am I audible?
Yes, you are.
Yeah. So I just have one question on the commercial side. Just wanted to know how are the rentals on the Pune commercial asset different from the micro market? Do we have any significant gaps or is it at par?
Hi, Saurav, Varun this side. So in Viman Nagar, Fountainhead, Pune is the latest Grade A commercial building that has become operational, and the rest of the supply in the micro market is at least 3 to 10 years old. We are achieving a net rent in Fountainhead of rupees 70 to 75 rupees for all 3 towers, and I would say that is at some premium to the existing rents in the market. We, in fact, we have seen some good leasing traction in the first 45 days of this fiscal year as well. And as of, in fact, as of this morning, we have leased about 1.25 lakh square feet for our commercial offices. This includes new leasing of about 1.1 lakh square feet.
Okay, great to hear that. And one more thing on the Tower 3, now that it has received OC, so the new, how the general new leasing discussion happening and the recent new leasing that you're talking about, is it on the Tower 3 or still on the Tower 2?
So, sort of right now, I would say that Tower 3, we have in fact leased the first floor in Tower 3 just a week ago. And Shishir alluded in his prior comment that we are in talks with some tenants for large areas wherein they can take multiple floors, for our various commercial offices as well. I would prefer to give, a more comprehensive update on Fountainhead Tower 3 sometime during Q2. So since we are still in early stages of discussions with multiple tenants but I would say the response has been phenomenal, and we are trying to balance out both the quality of the tenant and the area that they are taking vis-a-vis the rent expectation that we have.
Right. Understood. Thank you. That's all from my side.
Thank you. We have the next question from the line of Venkatesh from Tata Asset Management. Please go ahead.
Hi, thanks a lot for the opportunity. So my first question is, now that we are trending quite well in terms of consumption versus 2019 levels, if you could give category-wise some trend as to, how we are doing, how these categories are performing versus 2019 level. Is there a broad-based recovery or there are some categories which are doing better than the other?
So some of this is Anurag here. I think we are seeing a very good traction in terms of jewelry and electronics are the two items which we see along with fashions and accessories. These are in all the three categories which have come up. I think some of the cafes, restaurants and the movie theaters, etc. are just sort of coming back on track, and the content is being released as the pipeline of content is increasing. So that will come up over a period of time. But these are the three categories which I think are doing better than the others.
Right. And in terms of recovery, at least in terms of multiplexes, are we there at 100% levels?
Yeah, we are there at 100% levels.
Okay. Sure. Thanks for that. My second question is with respect to Chennai Mall. So when we look at the other malls, they are meaningfully outperforming this mall, right? So given that even in April, May, whatever numbers you've given, we are above 100% level, but still there's some divergence in the performance versus other malls, right? So just to understand what's really happening there, and if at all we're taking any mitigative measures to improve.
Hi, on this side. On the numbers that you are seeing for Chennai, this is a combination of Phoenix Market City Chennai plus Palladium Chennai put together. An important thing to note is here the hypermarket was Big Bazaar. And as you very well know, during the final quarter, hypermarket, which is a large contributor to consumption, Big Bazaar had its own issues. So that has been one of the impact here. We are now seeing stocks, etc., coming back, and thereby expect this consumption to pick up. Even separately on the other Palladium Chennai Mall, we have initiated certain measures to ensure that we are able to generate the kind of pull that this kind asset deserves. And with these occupancies also moving up, we will see this come back pretty soon.
Understood. Right. So then, when I see the leased occupancy also, it seems to be on the lower side, right, at 90%. So you expect that to pick up, and therefore then the consumption to pick up at a lag, right?
Absolutely.
Perfect. And my last question is, when I look at the EBITDA margins of the office vertical at mid 60s, it seemed to be slightly on the lower side, right? When I compare with the same vertical of some of the other real estate companies, because generally this is a vertical where the flow through is quite good, right? So any reason for us to kind of lag there?
So, Venkat, Varun that side, I think the reason for the low EBITDA margin, particularly for this quarter 4, was on account of brokerage payments that we had done on account of new area leasing in Fountainhead Tower 2. Given that, our overall portfolio is about 2 million square feet and we have about 0.6 million square feet of new assets, I think the overall brokerage payment in relation to the reported EBITDA may appear a bit high, but as the portfolio stays up, this will normalize. On steady assets, you will see EBITDA margins of 75% for Arcade House and Phoenix Paragon Plaza in Mumbai. And for Fountainhead, for example, if you see Tower 1, which is 95% leased, there the EBITDA margin is actually at 90%. This is also, to do with how these are structured in each respective market.
Right. So, I mean, on a normalized basis, post-stabilization, 75% is what we can expect, right?
75% for Mumbai and 85 to 90% for Pune.
Okay. So it will be closer to 80% at a portfolio level whenever it stabilizes.
Yeah.
Okay. Sure. Thank you. Thanks a lot, and wish you all the best.
Thank you, Venkat.
Thank you. Participants who wish to ask a question may press star and 1 on their touchtone telephone. We have the next question from the line of Niket Shah from Motilal Oswal Mutual Fund. Please go ahead.
Yeah, thanks for the opportunity. I think most of the questions are answered. I just had one question. If you can talk a bit about the enhanced app and other tech initiatives that you're doing, and how should one think about some of these initiatives contributing to our P&L over the next few years?
Thank you for the question, Niket. Yes, I'm very excited about this subject. This enhanced app, we have really seen a lot of memberships, and these are at different locations, but members can use the points that they earn across any of our locations. Bangalore recently breached 100,000 members club, and other locations will be adding to that. What this is really doing for us is giving us a lot of insight into our customer journey within our malls, and it's also helping us curate experiences and shopping and products for them. We have in fact upgraded our digital initiatives across various areas. We have a very, very strong CRM platform that has recently been implemented, which is helping us maximize our reach to our customers. The enhanced app is integrated with this, but we also have several other data sources which add to this CRM's capability. We are currently working on an e-commerce omni-channel platform, which is backed by the retailers who occupy spaces within our malls, and this will give us it will extend our reach beyond the cities where we are currently located. There are several other initiatives for customer convenience that we have recently incorporated, and they are rolling out at multiple locations, which include in-mall navigation. We're talking about proximity marketing. We're talking about geofencing, mobile triangulation. We have dedicated WhatsApp chatbot services, which are for customer convenience again and response to their queries. So we are seeing a lot of engagement, and of course through our website and our social media handles. So we are seeing a lot of engagement opportunities with our customers, and we have put in place the technology to communicate with them, and that will also have a a very positive impact on the consumption at our malls. I'm particularly excited about the omni-channel e-commerce platform, which we hope to have, start the pilot in about 8 to 9 months from now. And that will also boost sales and open another channel for sales for us, for our portfolio.
Got it. So the enhanced app will be separate and the omni-channel is completely two separate part of the piece, within the tech part of it.
They are all independent parts, but they come together cohesively in our overall digital setup. So CRM will talk to Enhance, CRM will talk to omni-channel. Our data science team will be getting access to all of this information to put together, a more robust digital marketing program, and to be able to also curate products and experiences. So it's all going to integrate seamlessly into the overall digital ecosystem that we are creating.
Sure. And what would be the traction that we would have seen on Enhance app, like in terms of, obviously there are a number of members which you highlighted, but there would be some traction that you would have seen, right, where people would have generated points and started redeeming the vouchers, and then that again leads to a virtuous cycle of consumption growth.
Yes.
Has there been any numbers that you can share?
I would say we have more than 300,000 members across the app, across multiple locations. And we are seeing, we track, we basically track our active users, who are basically users who scan their bills and earn points. So just to give you an idea, in Phoenix Market City, Bangalore, for the third quarter, we saw an average value of scan of about 14 odd crore for that particular mall. But total since inception of that program since December 21 is about 44 crore. And this continues to grow. At Chennai, it's already grown to about, we've had about 2 years of operation since we launched the program there in October 2019. We were shut for a year, let's say, during COVID. So for about a year, we saw our value of scans going up to about 142 crore in that 1 year period. So we are very, very focused on continuously engaging with the Enhance members and incentivizing them to scan their bills and earn these points. The earn-burn ratio is average at about 30% for when we track it on a quarterly basis. And this number will also increase significantly. The rewards usage ratio, so when our members unlock coupons for rewards, we're seeing the usage ratio being as high as close to about 60-65%.
Got it.
And also this Enhance also gives us an opportunity in the future. Currently, we are partnering with our retailer brands at each mall, and they are able to promote by way of in-app banners and videos, promote their product, but there's also a monetization opportunity there in the future.
Got it. The second question was, and obviously I'll take this offline on the tech part of it to understand better, but the second question was on the fee side of it, and I don't know if it's covered in the initial part of the remarks. If you can just give us some sense on how should one really look at this line item over the next 2 years. And one is that once you build your own incremental malls where you have partnership models, you obviously generate a fee income. But why not extend this entire fee income model to build malls for other mall owners which are trying to come into the country, and that can also be a source of income. So is there a business model case there?
At present, we are providing property management services and development management services and leasing services, because these are resources that are housed within a subsidiary of Phoenix Mills Limited. So we are providing these services to our own malls, which sit in partnerships with other investors and partners. For this current year of FY22, we've seen a fee income of about 100 crore from these malls. spread across property management, development management, and leasing fees. We expect this number for FY23 to be in the range of about 150-160 crore. This bump up will be on account of the new malls opening and new projects going under development as well, where we will be earning this fee income. The second part of your question, whether we will be looking at providing these services to other mall operators and developers, I don't think that is our intent. We want to utilize the maximum bandwidth that we have on a substantial portfolio of our own, and we see that we're going to be pretty busy for the next 5 years in building and delivering all our new malls. And just to give you an example, our leasing team in the last financial year was able to, across our new malls, not the operational malls, across our new malls, they were able to deliver leasing of more than 4.2 million square feet. That translates into 1,300, approximately 1,300 agreements. That's the quantum of work that our in-house leasing team has contributed to the group.
Got it. That's really encouraging. Perfect. Thank you, and I'll come back and you.
Thank you. Participants are requested to restrict your questions to 2 per participant. Participants are requested to please restrict your questions to 2 per participant. We have the next question from the line of Parvez Akhtar Qazi from Edelweiss Securities. Please go ahead.
Hi, good afternoon, and thanks for taking my question. So the first question is, what is the kind of capex which is pending in our mall and the office portfolio?
Okay, across our mall and office portfolio, which will also include the development at Lower Parel, the latest project is, I think the balance to be spent. Just allow me a second. The balance to be spent will be about 7,300. Just allow me 1 second.
Yeah.
I apologize for the delay, Parvez. We have a balance spend of about 4,600 crore across all the projects that are currently undertaken. This does not include Surat, but excluding Surat, the balance to be spent is about 4,600 crore. But we'll be happy to take this question offline and run you through the details.
Sure. And last question is, what is the expected completion timeline for the Calcutta Mall?
Kolkata, we expect to have it operational in FY20, latter half of FY26 or early 27.
Great. That's it from my side, and all the best for future.
Thank you very much.
Thank you. We take the next question from the line of Manish Agarwal from JM Financial. Please go ahead.
Yeah, hi. Good afternoon. 2 questions from my side. Firstly, the consumption in Phoenix Kurla does not seem to have recovered in the April month. It is at 101%, while the average portfolio is much higher. So any particular reason for that happening?
Hi, this is Pawan here. In specific to our Kurla asset, we were able to start our marquee events only from the month of April and May, and that too in the later part of April. Now, in all of our other assets, we were able to, in some form or shape, be able to bring back events, etc. And as you very well know, events are a cornerstone of achieving the consumption that you have seen across all our assets. I think that's the only reason why there has been a slight lag here. But other than that, PMC Kurla, at least in the month of May, seems to be on track with others. Also, a very important thing is from a leasing occupancy perspective and trading occupancy perspective. So Kurla has caught up a lot, and thereby we should be able to see similar trends across all assets in our first quarter of FY23.
Sure. Understood. Secondly, on the new malls which are coming up, so Indore and Ahmedabad more specifically, what would be the rough trading densities which you can expect going forward, or the consumption in these malls? Would it be in line with Palacio, Lucknow, or just to get a broad sense?
I think it should be fair to look at consumption or trading density trends closer to Phoenix Palacio, which was the latest asset that we added in our portfolio, with definitely Ahmedabad trending a little higher than that. But Indore should be much closer to our trend that we have seen in Phoenix Palacio. This is specific to the trading density question that you had asked.
Yeah, sure. And consumption?
Consumption should be a multiplier of that depending on the size. So basically, if you look at Indore is a 1.1 million square feet. So obviously the consumption will be a tad higher than Palacio. And Ahmedabad, effective with the higher trading density, should be able to trade at or higher than the gross consumption that Phoenix Palacio achieves.
Sure. Thank you. That's all from my side. All the best.
Thank you. We have the next question from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Two clarifications. One, in the retail assets of our, what would be our blended holding post this transaction of the Classic Mall, so that we get a understanding of your share of the retail revenue, or rental revenue, sorry. And second, my question is on the office assets. There is this slide about new agreements of about 180,000 square feet. So is it possible for you to give us 180? So is it possible for you to give us a clue in terms of we have the capacity available, considering the Fountainhead 2. What kind of utilizations we'll see over the next couple of years?
I apologize, but can you just repeat your first question again?
I want to know our blended holding in the retail rental revenue.
No, you're talking about across the portfolio.
Yes, of the portfolio.
Okay, let me put it like this: that we have in Phoenix Market City, Chennai, which is a 1 million square foot mall, we own 100%. Lower Parel, we own 100% of the existing mall, which is going to be roughly about 1.2 million square feet, excluding Rise. We own 100% of Phoenix Palacio Lucknow, and the two smaller malls, Phoenix United at Lucknow and Phoenix United at Bareilly. In the other operational malls, Phoenix Market City Bangalore, we own 51%. In Phoenix Market City Mumbai and Phoenix Market City Pune, we own about 67%. And we own about 74% today, and we'll be at 67% once the subsequent infusion is concluded by GIC. In the under construction malls, we own 50% across the board.
Okay. So the Indore and the Ahmedabad is 50%.
Indore is 50%, Ahmedabad is 50%, Mall of Asia Bangalore Hebbal is 50%, Phoenix Mall of the Millennium Pune is 50%, 51%.
So from an existing portfolio, Market City Bangalore, Market City Pune and Market City Mumbai is where you have less than 100% holding. That's about 64 you mentioned, 65%.
So blended average would work out to about 86%.
Sir, that's
of the overall GLA.
I was looking for that simple answer, sir. Okay, and on the office asset side, if you could give us what kind of leasing activity growth that you see over the next couple of years? So you have, I think you have leased out 890,000 square feet, which I can see from your presentation. This 890 should be what number in next couple of years?
We are expecting, okay, so our operational portfolio today is about 2 million square feet. This includes Fountainhead Tower 3.
Yes.
Right? And out of this 2 million square feet, currently we are at a leased occupancy of about 1 million square feet.
Perfect.
And we are expecting this to move up to about 2 million in this current financial year.
In this current financial year?
Yes. And over and above this, we also expect to do some pre-leasing for the new offices which are under development. We've set out some targets for our team on that. Should be in the region of about anywhere between 600 to 800,000 square feet.
Okay. So this million to 2 million, you have the necessary visibility. So it's all because I don't see in your presentation. Usually you have given in your retail assets how much is pre-leased, but you haven't given that in your rental assets, office assets.
We have shown what is the area leased. If you go to slide number 44 of our investor presentation,
yeah, I can see the area leased. Yeah, but from 1 million to 2 million, you haven't mentioned anywhere in the presentation. So that's what I.
Yes, because it's a forward-looking statement, and that's our best estimate at this stage.
Okay. Thank you very much, sir. Thank you.
Thank you. That was the last question. I now hand the conference over to Mr. Shishi Srivastava for closing comments.
Ladies and gentlemen, thank you very much for joining us for our Q4 and full year FY22 investor call. We look forward to interacting with you during this coming quarter and at the next investor call. Thank you very much for your time.
Thank you. On behalf of Phoenix Mills Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.